Started. And today we've got Aaron Richmond with Endeavour Capital, which is the largest private equity firm based in the Northwest and kind of focused on our region. And Aaron is a managing director with the firm and has been there for 24 years. So despite his youthful appearance, he's got a very lengthy experience. So I'm just going to go ahead and kick it off with a number of questions in a typical interview format here today. But along the way, since we kind of have a discrete group, if you've got questions, either just raise your hand and ask them, or send them to me in the chat, and we'll get your questions answered. But I think we're just going to really start off with what is your background, Aaron? And I guess we have already kind of answered the question, how long you've been at Endeavour, but what did you do before you joined Endeavour Capital?
Yeah, it becomes a little less relevant because it's now 24 years ago. But I worked as a management consultant with McKinsey & Company, and pretty quickly decided I wanted to be outside of the advice-giving world and really kind of get involved with small and mid-sized companies and candidly be back home. I'm from Oregon, little farm town in Oregon near Eugene. So I was very excited to come back to Portland. Endeavour, we all started in Portland, Oregon, and then I opened up a Seattle office, and we've raised a series of equity funds since then.
And did you start in the Portland office, or did you move to Seattle?
Yep, and then moved subsequently up to Seattle.
Okay. Well, Aaron's being a little humble. He's actually also has a very prestigious academic background, including undergraduate degree at Harvard and an MBA at Stanford. So, great background that you have. Kind of the next question is, most of these Meet the Investors that we've organized over the last year or so have been venture funds and angel funds, and you represent our first private equity fund. Can you kind of describe, what private equity is and how it's differentiated from, angel funds or traditional venture funds?
Absolutely. And this is an important question I want to spend a few seconds on. And this is a place, please ask questions, because there's a lot of jargon in our industry. Some of it intentionally confusing. So I'd love for people to ask the dumb question, because it's not a dumb question. I may not be able to answer it, and others are probably wondering it. So private equity, first of all, it's all private equity. Venture capital is private equity. Those aren't publicly listed companies. Angels, that's private money. So private equity is basically, you roll back the 60s and the early 70s with the start of this asset class. Those early funds were primarily focused on high growth companies and a business model where you make a few bets and a few of those turn out fabulously well, and then others, you kind of get your money back or don't get any money back at all. And that was the early venture capital money. And at the same time, there was what was called leveraged buyouts, a term I'm sure you've heard of before. And those were the early KKR investments. In fact, actually, our company, U.S. National Resources, which is in Woodland, Washington, it's the largest sawmill equipment manufacturer in the world. It was also Colbert, Kravis, and Roberts individually second ever deal. They did it in Woodland, Washington. Incredible. And we just bought it from them about 8 years ago. And back in the day, those leveraged buyout investors used 80% debt and very little equity to get control of profitable quality companies, the sort of companies that we like to invest in. And that worked out very well for them for a period of time, until you hit an oil price crisis, or until people start saying, 80% debt, I'm going to try 100% debt, and then problems ensued, and that leveraged buyout name really got a bad name for good reason. People abused the approach. And at the same time, also, it was realized there are some quality older economy companies where you're really not going to use a lot of debt to buy the company, and really the company isn't for sale. but they need to raise equity, and it's not venture capital. It's what became known as growth equity. And so the term private equity came to kind of replace that old model, leveraged buyouts and growth equity capital. And quite frankly, we do a bit of both. We buy some companies using leverage, and then we buy into other companies using mostly equity and maybe a small amount or no debt. So that's really where the term came from. But our model is very different from the venture world because we want to hit doubles and maybe the occasional triple. Once in a while, a wind comes and takes the ball out of the park, but we don't. If we try to swing for home runs, things usually don't work out well. With the venture world, boy, they look at some really great companies, but they say, we're only going to double our money here. That's really not enough in their world. They need to have a home run, or just understand they're going to strike out, and that's okay because it's generally a lot of younger people. Everyone's going to go home, try it again. They don't have 4 children. They're not halfway through their career. It's fine. These are businesses that are designed to really expand greatly or fold up. In my world, we don't want any of our companies to go down. We don't want to have layoffs. We don't want to shut plants. There are environmental liabilities, there are union issues. There's a couple thousand employees, whose lives are dependent on it. So, hopefully our model and the way we structure these is designed to be more careful with these companies. And so we kind of take hopefully a more middling return, a little bit more steady, whereas the venture guys, a lot more risk. But strangely, over a long period of time, the two of us come out about the same place.
That was a question I was about to ask. Despite the fact that they're rolling the dice for the next Facebook or Google, if you look out, because you guys have been around for 29, 30 years now.
30 years this year, yeah.
If we really looked at the returns for your asset class or your fund in the venture funds, is it really all that different after 30 years?
Yeah, there's a lot of debate about that, Tom. In general, people tend to say value-oriented investing, the private equity funds have done better than the venture funds on the margin, but it's only slightly better. But it masks long periods when the venture funds do way, way better and way, way worse. By long periods, I mean like 10 to 15 year type stretches when it can be like that. Right now, there's so much capital out there. It may be a push. I mean, the valuations venture people are investing at are very high, but we have so much competition, especially the largest funds are really coming quite a bit closer to public equity investments. And that's one other, just sorry to be rambling. One other quick observation that's kind of interesting is, back in the day, we're investors in, Esco, a wonderful family-owned business, 80 to 100 in EBITDA, or Winco in Boise, in hundreds of millions of EBITDA, or Vigor Industrial, the shipyards company in Seattle, in the 80 to 100 zone. Those are public companies, back 15, 20 years ago. And in fact, Vigor was public. It was the Todd Pacific shipyard, which we bought and took private. But it became impossible with Sarbanes-Oxley and other regulations for those small cap companies, micro cap companies, to stay public. So now, who's an investor in Endeavor? Well, it's the Washington State Investment Board, Percy, the Public Employee Retirement System of Idaho, Colorado, University of Washington. Same people who invest in Fidelity and the other large funds. So in a way, we're not a public market. We are private. Some of the same investors, so we're kind of this gray market between public and family-owned type private. So it's like it's institutional private money.
Good. Well, that's very helpful, and you clearly have a blue chip investor base. But before we kind of explore some of these other topics about your firm, what you've been around for 30 years, or about what your 30-year anniversary comes up. Who are the founders of the firm, and kind of what inspired them to start Endeavour Capital?
Yeah, Rocky Dixon and John von Schlegel. Two guys from Chicago. Both Rocky moved out, went to the University of Oregon, and John wanted to be on the West Coast. Back then, as you remember, Tom, there was a lot of capital available, or there was not a lot. There was capital available for venture funds. You remember Shaw Capital and a handful of others. But really very little money for what you'd call traditional economy businesses in the Northwest. There were not family offices. And so the idea was to bring a long-term patient capital source that matched up with businesses that had 20, 30-year business plans. So different from the pace and the growth of venture funds and matching more of the profile of a traditional economy company. And it's funny, over time, a lot of that has stayed exactly the same. Now, what's your traditional economy company? A lot of these software companies, they've got a niche. We're 8 in EBITDA. We know what we're doing. To us, that's traditional economy now, even though back then we would have said, oh, that's a tech company. They apply technology, but no one's going to come out of left field with a whiz-bang solution that puts them out of the business. And that feels a lot about like what we do now. So believe it or not, a quarter of our companies are software and technology businesses.
Okay. And the two founders are still involved in the firm?
Yeah, both still involved, both active. John von Schlegel is our chairman. Rocky, biggest cheerleader. So it's been great. Very little turnover, as you'd hope.
Fantastic. Now we'll talk a little bit more specifically about what your focus is. What are you looking for in terms of industry, geography, size, both in terms of revenues, EBITDA, those sort of things?
Yeah, you bet. So they're all different ways of funds developing some anchor to windward, in a market where there's just a lot of capital out there. Somewhat depressing, to be honest. You have to have some focus, and our focus always has been a geographic focus on the U.S. West Coast and Intermountain, kind of Great Basin region. So we have been in this region, as Tom knows, just kind of tilling the soil for years, getting in front of companies directly. We have a pretty diverse group of industries that we've been in, and I'll go through some sample investments in a little bit. So we really, the key is geography, and then frankly, it's kind of cultural fit. We tend to, if someone wants to sell their business, if they're selling the house, we're not necessarily the best partners. If they're wanting to bring in a roommate, for a 10-year run, and really remodel the house and then sell it later for a lot of money, that's probably a better fit for what we do, because we like partnership, mindset. And the companies generally are kind of 50 to 150 million revenues on one range to 350 to 600 million in revenues. So they're generally bigger, better established. Earnings matter, so 8 to 10 in EBITDA, up to 40 to 50 in EBITDA, and then they kind of grow from there. EBITDA is a bad habit that our industry's gotten into. That means earnings before interest, tax, depreciation, basically a surrogate for the cash flow of the company. And that's what we generally look to put a big multiple on to value these companies. Those are just kind of rough parameters. The honest answer is we've invested outside of both of those. We've backed management teams. We just started a software consolidation in the beverage space. We were the largest direct-to-home shipper of wine in the country through a company called Wine Shipping. We're investors in Columbia Beer and Wine Distributing for years, so we know a lot about beverage. And so we bought 3 smaller beverage software companies that help merchandisers in the field, help manufacturers track product sell through, et cetera, and are building a platform. So that business has started with 3 1 to 0 EBITDA companies and a management team that's really expert. So we do occasionally do that, where you're backing a management team to go buy companies that will over time grow with us.
Okay. I like that analogy, selling the house versus a roommate, and you prefer to be roommates. So if you come in, and I don't know if an average or a typical applies, but if you've got a company that is looking for a roommate in a private equity firm,
Yeah.
what percent of the company do you typically buy? Is it 10%? Is it 90%, or
Yeah.
somewhere in between?
To continue the analogy, sometimes we get the small bedroom, other times we get the big bedroom. So, you know, Willamette Valley Company, a long-time family-held company, makes adhesives and paints, glues for the forest products industry and infrastructure applications. There were a majority. It just made sense for the family to take a larger chunk off the table. Columbia Beer Wine Distributing, Esco, Winco Foods, we were minority investors. You know, honestly, we try to. It's not about us. It's about what this company and this family
Yep.
needs, and then we'll kind of figure out how to manipulate our model, if you will, to fit that company's needs. So we can kind of be either. And you know, the legal documents go from 8 inches high to 1 inch high, depending on majority or minority, and that's an exaggeration. But
Yep.
the reality is the board meetings don't feel different. Your interactions don't feel different. We don't get any smarter when we're majority owners. Um, you know, they're very similar types of partnerships. It really has more to do with what the company is up to and what they need.
Yep. Before I ask my next question, I want to remind everybody here to feel free to jump in if Aaron says something, or if you want to do a deeper dive, please jump in with questions. But you know, in addition to liking your kind of sell the house and your roommate example, I also like that you said, you know, you're kind of looking for a cultural fit, and that's very appealing. And on your website, you talk a lot about stewardship. Why don't you kind of highlight how your stewardship and your cultural fit likely go hand in hand in the way that you both look for opportunities and then manage those opportunities?
Yeah, you know, there are a lot of finance guys in the world, gals, right now, and many of them have experience with investment banks where you get, you know, paid quick sale at the end of the year, and then you're off to the next one. And that culturally is a very fast pace, you know, buy it here, sell it here type mindset.
Yeah.
And that's really never been our deal. And it kind of goes back to our family heritage, if you will, in terms of the investment fund. We've been very careful to kind of bring in people who want to be with Endeavor for the long term. They have some anchor to our region, so that we're thinking they're going to want to, you know, raise their family here as well.
Yeah.
And then we'd like to be with these companies where, you know, you just enjoy the people you work with. There's a life's too short category.
Yep.
As especially as you get older, more experienced, do you want to work together? And, you know, 7-10 years is a long time. And we've been in 10 to 15-year partnership. So you kind of want to become friends, because if not, you just don't want to be in businesses where like, the Endeavor guys are coming, you know, that we don't want to exhaust our partners. We want them to look forward to the discussions we all have together. We want them to desire more interactions and interactions to come easily. And frankly, there's an investment side of it too that you can't put numbers to, which is companies with strong cultures. They hold together well, you know, and they tend, in our opinion, to build value over long periods of time. And in any given short window, someone else can, you know, pop them, beat them to this or that punch. But over the long haul, those strong cultures are really where the big money's made. So there's a long-term greedy side to it. As well.
I also like what you said, that you try to leave a company in better condition than when you first invested. And
yeah, it's, you know, the regional investment. I was like Washington Trust, you guys, you know, when you're investing in your hometown, you're going to see each other. So again, long-term greedy, you want to feel good about the way you've handled these companies. You want your kids hearing good things about you at school, because they're going to run across kids of partners of yours. the Washington State Investment Board's your largest investor. You want them to hear good things about what's happening in Woodland and employment there. So, there's a lot of reasons, but it's also just kind of who we are. It makes you proud of how you're at.
Great approach. We have a question from Lars Gilbert, and Lars runs or manages kind of the University District, which is adjacent to downtown Spokane. And that's where we have the concentration of Gonzaga, the UW Medical School, WSU, Eastern, and Whitworth. It's really kind of just a great presence in downtown Spokane. And Lars is the kind of the person who kind of looks out after all of that. So Lars, fire away with your question.
Yeah, and it's just kind of a combined question, but I'm just wondering about the flow of, if it's kind of more of a static hold with holding some of these investments for so long, what's the capacity really to look at new deals, and if that's being funded through new equity or wealth that's being invested in, or what? And then kind of conversely, what's triggering divestment, of just like it's the right time, or we want to free up capital to kind of reposition the portfolio? Just kind of curious.
Great question. Yeah, Lars, so we have dedicated investment funds. So we just closed on our Endeavour Capital Fund 8. So that's $850 million raised from our group of investors in our region. And we will put that to work over the next 5 years and be in those investments, and ultimately need to have liquidity for investors 15 years from now. The investments get made over that 5-year stretch. And you're right, if you're holding for 10 years, but you're raising funds every 5 years, then your portfolio is getting bigger and bigger. So we need to keep grooming our internal group, which is how we started from 2, 3, 4 guys to 35 men and women now, and slowly kind of growing from there. But end of day, we probably make 3 to 4 investments a year. So again, in contrast to that venture world, it's not a rip-roaring pace. A portfolio for us is 11 to 14 companies, whereas a venture fund might have 20 to 30 companies. I'll sit on 4 to 6 boards at a time. A venture fund manager might sit on 10, 15. It's remarkable the spread that they have. We get quite a bit more involved in these companies and physically are there quite a bit more. And the venture funds don't need to, quite to the same extent. The money comes from, now at this point, it is some amount of recycling. It isn't specifically, the state of Washington doesn't say, hey, we've been in funds 4, 5, 6, 7, we're going to roll that into 8. But it is, they've made enough money where they keep clicking up with us, and same with other investors. And then that's true also for the management teams that we've invested with. They've had wealth creating events in prior funds, and then they like to invest in later funds, and they like to see our annual meeting yesterday. Getting all these texts from the guys I worked with 10 years ago. I'm about to ask you a question. All the annoying questions I asked in annual meetings. They'd be ribbing us about it. It was really pretty fun. They like to see us in the hot seat. So it's a nice way to stay in contact with some of these people that you've had a good partnership with.
Hey Lars, since we always like to kind of highlight Spokane to people outside of the region, can you just tell Aaron what the picture is in the background that you have on your screen there?
Happy to.
Yeah, I don't recognize that building.
So the Catalyst building is pretty impressive. So it's one of the greenest buildings in all of North America right now, and definitely one of the greenest buildings in all of Washington for commercial space. And it's being supported by an eco district that balances the energy production and use, not just electricity, but across energy types. And it's designed to be able to support multiple buildings, so that rather than just having to constantly invest in infrastructure, that we make our buildings interact with the grid better, allow for healthier environments. It's not just carbon neutral in its operation, but it also stores carbon in the cross-laminate timber in the building. So more I could share, but if you ever have a chance to go in the lobby, and when people here locally, there's actually a display that shows in 15-minute increments how the energy balances out with production and consumption. And it was designed in partnership with the students. So this is where, again, where business and education grow together, and the building's a great example.
Is it a
Awesome.
cross-lam timber building or just has some cross-lam in it? Oh,
Yep.
wow, that's great.
The outside shell that it's terracotta. So the goal was to have as little of an impact in the environment in building the building as possible.
That's neat.
Fantastic. Thanks, Lars. We've got a question from Ryan Kennedy. Ryan, go ahead.
So Aaron, with the changes at the federal and Washington now proposing a capital gains tax, how do you think that's going to affect the private equity funds generally in your investment strategy going forward?
Yeah, great question. We've seen this movie before, you know, 2 other times when taxes were popping. It means we're going to have a real busy year because it's, boy, these are big changes to capital gains, and I don't want to be political, but it is, you know, there's an advantage to having people thinking about gains differently. And so this will spur a lot of people to think about taking some chips off the table, without a doubt. But then on the other side of that, then you have the really slow year. So it's kind of aggravating. Does it, I'm not sure it really will change our business beyond this surge and then slow down. And it's going to be interesting. In Washington, I bet that's kind of a protracted deal. So that ball might roll down the hallway even for more than just a year. It'll be interesting to watch. There are people way above our pay grade who are very focused on it. But that uncertainty is always painful.
Excellent. We have a question from Carter, and Carter, his company isn't quite at the stage. He's more at venture stage. He works for a Y Combinator company right now, but he's also working on an idea for a new business. Carter, go ahead with your question.
Yeah, I was just wondering how exit works with private equity. So specifically, are you waiting on IPOs? Are you selling on secondary markets?
Yeah, great question. You know, and I didn't answer the question before. When, you know, how does exit happen? First of all, when does it happen? It's a little bit of, it just seems like it's the right time. You know, our management teams generally focus on ramping earnings, and that's critical. We and the board are there to help really increase the multiple as well. And, you know, that 1-2 punch of growth in earnings and at a higher multiple is how a lot of value really ultimately gets created. IPOs, let's see, we've had 3 companies go public over the years, and that's great. Candidly, we wouldn't wish it on any of our management teams who we like. You know, being public, it's kind of a sucky thing. You don't actually get your money out. You know, you might get a little bit of money out at the public offering and then more 6 months later, but it's not really an exit. It's a financing event where you raise capital for the business, and you really need to have a lot of momentum and a good purpose for the capital, especially for the infrastructure that you're loading onto that company. So it's generally not a fit for our types of companies. Every once in a while, we do have a business where it's just headed that direction. For years, the exit was a larger strategic buyer that wanted to own this niche, that seemed like a responsible owner, cultural fit, et cetera, and they'd come find us. And that's still maybe half of our investments. But half of our investments are now sold to other much larger private equity firms. I mean, Endeavor's first fund, we were 20 million. And, you know, I thought, wow, someday we might manage couple $100 million, and like the biggest number I could think of, you know, and here we are managing 800 million in the most recent fund, and we are tiny. I mean, there are so many multi-billion-dollar funds out there. It's extraordinary. And the brand names you actually know are in the tens of billions of dollars under management. Those guys really need to put money to work. And so a big part of our job is getting our companies up to speed to where if one of those guys is interested in our space, they're able to buy it. They're very different than ourselves. They're very institutional. I mean, they're much more like a public company. And so they throw dozens of advisors, during the diligence. They're much more like kind of asset managers than kind of business partners, but they can be good owners. The company just has to be ready for it. But they also sometimes are willing to really pay top prices once a company is able to fit into the narrow box they create. So that's kind of where the exit ends up being for us.
So your answer, your response kind of prompts two questions by me. You said 3 of all your exits, 3 have been through IPOs. So how many exits have you had in total?
Yeah, 65. We've made 65 platform investments over the years. Please, no one do the math. That's 2 deals a year. So again, not a rip-roaring pace.
Yeah.
And we have 15 to 20 companies currently in the portfolio, but really only one of those would be on an IPO track. So I included that in one of the 3.
So you at the high end, you've had 50 exits then.
Yeah.
But only 3 through IPOs. Wow. Okay. And then you said something interesting. You said half of your exits have been sales to other private equity firms. How many?
Last 5 to 10 years, Tom.
Last 5 to 10 years.
Yeah. And that's going forward. Over the long arc of time, it would be more to strategics. But
okay,
it's a new world.
How many companies have you bought from other private equity firms?
Oh, yeah. 0 to 1 to 2.
Okay.
Yeah, because a lot of our business, and maybe as we've grown a little bit, and there are some new generation funds who are smaller than us, maybe that will change. But usually we're the first private equity fund in. We're kind of helping that company transition from founder and family ownership to this semi-institutional ownership. That's kind of what we are. And then those bigger funds or a strategic buyer would be kind of a full institutional ownership.
Yep. On a topic related to IPOs and exits, we've got a question from Mark Gustafson on SPACs. And Mark is one of the senior officers at Vista, our publicly held utility in Spokane, that really is very actively involved in supporting all the entrepreneurial initiatives here in Spokane, including Ignite, the organization that I'm part of. So Mark, fire away with your question.
Thanks, Tom. Hi, Aaron. I appreciate this. It's been great so far. I got introduced to SPACs more directly with one of our portfolio companies in the energy space, as Avista participates in some funds as well as direct investments that are strategic for us. But I'm just, as I get to know this and kind of watching the Wall Street Journal, I'm just curious of your opinion on, this SPAC phenomenon going on. Is it irrational exuberance, or is there really a problem that it's solving that PE and venture is not taken care of in the market?
It's a good question, and TBD is the answer. The first part has been some irrational exuberance, and it would be wonderful to own a portfolio of energy companies or some of these other areas because they do have access to capital and they are irrational. So your portfolio company should take inquiries seriously, even though it may not make sense. Long term, we always worry about that. If it really doesn't make sense, is this really the right thing to do? Because sometimes there can be a real backlash. These early SPACs are very much momentum plays. And again, that tends to make us queasy, but honestly, we're super conservative and we entirely missed out on the .com boom. So it's like, just know who you are. That's not our type of thing. But remember how I was talking about public offerings and how I'd say a solid third of our companies 20 years ago would have been public companies and no longer can be because of Sarbanes-Oxley. I mean, they are too small. That is kind of a shame because that keeps smaller investors from having access to really great value and growth companies. And so the SPACs are a little bit of a runaround. This may be oversimplification and not totally fair, but they're a little bit of a runaround on some of the registration requirements and the way you can a forecast and conduct diligence into a company. And so some of that is unfair, but it's also addressing a need, which is, or a desire, which is of smaller investors to invest in some of these micro cap companies. So from that perspective, provided the SEC doesn't say this is a runaround and we're not going to allow it, they could be here to stay, you know, as kind of this yet another tweener way to be accessing institutional capital. It's a hard one to predict. SPACs have been here before. We've seen these run-ups maybe a decade ago. There's a similar burst in activity, but this is way bigger and feels broader. So I think a lot of it will depend on this administration and the SEC team and how they decide to react to it. If they decide retail investors ultimately are going to be hurt, which could happen with some of these kind of goofy things that are getting forecasted, then it could get clamped down and might sizzle out. But I personally feel like there is some tweener role, even though they're probably competitors to us.
Have you ever looked at or done a going private transaction?
We have, like the Todd Shipyards deal. They are very hard, but they are doable. Every time an industry gets hammered, you know, you get a bunch of calls on going private deals, and really a company that has a stock that just goes down, that company's not for sale at that new low price. You know, you have a group of investors who remember the higher price, and they're not selling at the lower price. So you really need an extended period at the lower price where shareholdings have turned over, and an investment bank will do an analysis of the average buy-in price of a shareholdings group to see if that's the case. You need a block shareholder, maybe a 30%, 40% shareholder who says, I want to stay on private. I'm voting yes, I'm in, you know, so that you have momentum for this. And you need to have a management team and board that just can't wait to get sued, because they're going to get sued. Yeah. They're going to be nuisance lawsuits. The insurance company's going to settle. But quite understandably, you know, I wouldn't want to get sued. And I don't care if you say that I'm indemnified. I don't want to get sued.
Right.
Right. And so you need to have some willingness on the part of board and management to unfortunately take some uncomfortable risks. So they are hard to make happen, but they do happen.
Yep. Another fun fact question. I know there's a company in Seattle, Physio Control, that I think has been owned by Bain Capital 3 or 4 different times. Have you ever bought a company twice?
Yes, in a sense. Columbia Beer and Wine Distributing, we have been investors in twice. That's a very rare situation. I saw one. I'm only half looking at chats because I'm trying to make eye contact. We have done a number of industry consolidations. Columbia Beer and Wine Distributing has been now 25 years of buying beer and wine distributors. We're not currently an investor because we sold to a much larger family, but they're continuing the consolidation. But we sold our interest, and then they landed yet another larger acquisition, and again needed financing, and so we came back in.
Okay, we've got a question from Rick Rep, and Rick is a senior partner with Witherspoon Kelly in Spokane, one of Spokane's most prestigious law firms, and he's one of the leading securities attorneys in Spokane. And Witherspoon is also the sponsor of Ignite Talks. So really appreciate Rick and all he's done for us. And Rick, fire away with your question.
Okay, thanks, Tom, and thanks, Aaron, for this great presentation. I'm learning a lot here. You kind of touched on it. The chat comment you addressed with the beverage industry was my question about, you know, how many other industries have you done a roll up in? Because that is a common PE model that we've seen. We've seen some companies in this town sell to PE companies that were doing a roll up. But then I also have an unrelated question, which is you mentioned you have a team of 35 now, and I'm wondering what your intake approval procedure is for new investments. So 2 unrelated questions.
Sure. So starting on the consolidation plays, there are good and bad ways of doing it. You know, sawmill equipment, radio, beer and wine distribution, shipyards. We right now, medical devices manufacturer, the beverage software business I mentioned. In our opinion, you know, they can be done poorly, where you lean a bunch of companies together real quickly and try to sell to someone else. And people make money doing that. This tends to be more the investment bank thing. We call it leaning a bunch of drunks together. It's aggravating because you see these guys just buying all these things and then they sell it, and then the whole thing collapses later because there's not a cultural alignment. Some of the businesses didn't really belong together. They're kind of unfortunate, yeah, and they give our industry a bad name. But there is real room for consolidation in a lot of industries. Shipyards went from being the most horrible business with no capital available to put back in these yards to under Frank Foti and Vigor's leadership, where we had multiple yards up and down the region, and we could balance loads and capacity. We could put capital in to different size dry docks and different markets, and the vessels could move, you know, to the yard that had the right fit for their needs. You know, that we made more money, we provided better service. You know, that made a ton of sense. So they're very legitimate plays when executed well. Rick, if you're advising a company that's thinking of selling into a consolidation, you know, it's just, again, if they're selling the house and they don't care what happens, you know, to the residents, maybe it doesn't matter, but you want to check pretty carefully on that consolidation, their philosophy, how quick they're going, whether it really makes sense, because there quite a few of them have had some struggles, and I'd say about, you know, a good number of business owners maybe wish they hadn't sold into consolidations, especially if they took equity. Other times, if it's really well designed, good team, they can be great, and it makes sense to roll equity. And then, so 35 team members, meaning professionals, support staff, and so on. And we hire usually 1 or 2 younger people a year. But I think your question was more about, you know, our deal flow and finding new opportunities. And we call directly on companies, and usually they're not looking for money. You know, it's quite rare. We're investing in profitable businesses, but you kind of know that over a decade stretch, you know, Aunt Sally's going to want out. That goofball competitor is finally for sale, but we need to come up with 20 million, and, you know, we don't want to put that much leverage on the business. The family would rather manage for some amount of income, but it makes sense, you know, until you bring on a minority or a majority partner to make that acquisition. Plant expansions, you know, some company, the dog gets hold of a car, it takes off on them. The company's going to be a capital consumer for years. You almost have to do it, or you're not really staying in business. But is it really right for that founder maybe to be writing all those checks at a given stage of life? Those are the reasons we tend to get involved. And that's why we stay in touch with these companies over a decade-long period, is we have some faith that one of those 3 is going to come up.
So when you find them, what's the approval process within your company?
Okay.
Do you have a board, a committee?
Yeah.
How does that work?
Great. Yeah. No, we still don't have an investment committee. That's a matter of debate. As firms get larger, you know, people management, culture management gets important. Investment committees in our world can breed politics. You know, it's possible Jack is smiling about credit committee right now. You know, you want to be careful not to have, in our opinion, politics start to overtake decision making. And so instead, we are still partnership decision making. We have 7 managing directors, 11 partners out of those 35. And decision making tends to be more incremental as we review opportunities. And it's either trending towards approval or it's trending not towards approval, as opposed to a star chamber of 4 guys and gals who ultimately make the decision. Usually our opportunities take like 3 to 4 months to figure out what does the company really want to do? You know, and so we're kind of going back and forth on LOIs. You know, family members are making different decisions. It's almost like you're trying on different clothes, and then you finally find one that fits, and then it's a 30-day sprint to close. But usually at the start of that 30-day sprint, you kind of know you're in, and then that 30-day sprint is bringing the lenders along, verifying through accounting and legal diligence that there's not some big bad ugly that you or they didn't know about, and just documenting the dang thing.
Good. We've got a question from Harsh Sarana. Harsh, why don't you just kind of give a brief introduction of yourself and then ask your question?
Hi, Tom. Thanks. Hi, Aaron. So I'm actually an MBA candidate, and I'll soon have a startup of my own. So I just wanted to understand that what matters to you when you're looking at companies, because you're very selective when choosing a flat. So I want to understand what matters to you when you choose to be a roommate, and what non-financial indicators are really important to you, because we all know that financial due diligence is done and legal due diligence is done, but what are the major non-financial indicators that help you gauge the potential of these target companies?
Totally, George. You know, we all get super focused on the legal and the financial due diligence because, you know, it's right there. You can read it, you know, look and underline and decide, oh, sorry, I've got an Apple pen. I don't just under pencil underline anymore. But it feels very concrete. And so you fool yourself into feeling like you really know what's going on. And there's some truth to that, but end of day, and we learned this lesson over and over and over again, all businesses are people businesses. And so you look at some of the big facilities we have, some of the grocery stores you have, and you kind of feel like, oh, you know, they're still people businesses, and you lose a couple of great people, you add a couple of great people, you can have one heck of a change. So 80% of our diligence needs to be, and we do forget this, the quality of the team that we're partnering with, you know, their energy level, their alignment, their ability to push authority down, their desire to grow just because it's who they are, their vision for growth, and their willingness to kind of bring other people along and share in that. Those are just great fun deals, and those can be in some really cruddy industries. I mean, that's the weird thing about it, and that's you know, that's what can be surprising. Is that we'd much rather great management team in a bad industry than a great industry, great company, but where the management just isn't making it happen, because ultimately that advantage that they may have will tend to erode. And you see people doing lots of weird things to each other, especially in lower mid-market companies. So whatever you can do from a public company perspective, watching management teams on quarterly calls, listening to them, that sort of thing, you get a sense for whether this leadership, whether these are really business people who care about their company and they're not afraid to tell the market, stuff it, this is the right thing for the business, we're doing it. Or are they politicians, you know, who've risen to the top of a large company because they're great politicians, but they're not necessarily great business leaders. We and you probably need to be careful of the political types.
I'm just going to highlight one observation here. You know, you're listening to a 24-year veteran of private equity, and you know, the way he's answering the question is just reeks of experience. Because if you one thing that's really important when you pick a partner, whether it be a venture fund or a private equity fund, it's so important if ideally if you can get someone that speaks for the firm and has been through market cycles, because the way you're answering the questions, I'm guessing perhaps are way different than you might have answered them 1 or 2 years out of your Stanford MBA program. Because you're focusing on the nuances and the things that are really important. So this is incredibly helpful because the experience is just oozing through in your comments.
Well, thank you. That's the hitting every iceberg between here and there experience, without a doubt. Yeah, it's not just it's not reading about it.
Yep, I know the feeling. I've got scars in my back from
exactly
years of learning.
I mean, just as an example, we had one former owner who bugged the office of his CEO successor. So the weird things people do to each other. I mean, we've got such a long list of stories, but just when you say, you know, I've seen everything, in fact, don't say that aloud, because you're about to have something even weirder appear in your portfolio.
Exactly, exactly. We got a question from Chris Malday. Chris, why don't you just give a brief introduction of yourself and then ask your question?
Yeah, thanks, Tom. Thanks, Aaron. This has been super interesting. I founded an investment firm a few years ago. It's a registered investment advisor, but we focus on investing in individual securities, common stocks. So my question is really, what options do you have for a portfolio company that's doing really well? You'd rather not exit, but the time is running out on your fund, and is there an option for a side pocket or other things where you can maybe hold on to the interest there, or do you really have to sell that company when the time is up on that fund?
Yeah, Chris, great question. This is another way our industry is staying the same, but actually evolving. So, like Tom was saying, I not only would I have answered this question differently early, I would have answered this question differently last year. The market right now is such, we never would have wanted to sell Tidewater or Northland or our Winco interest or anything if we'd had alternatives. In today's market, there are actually, especially a fund that's been around for a while, has a track record with its LPs, to say, not for a third of your portfolio, but for 1 to 2 companies out of 13 to 14, say, guys, we think this is one of the special ones, you know, and you've seen what we sold in the past, and you and we both regret it, but we had to. This is a special one. And here's the deal. We're going to create, I'm forgetting the name of it. It's not a discretionary fund, but it's basically your phrase, like a sidecar fund. We are going to create a fund to buy this interest from the main fund at this price. Anyone who wants to stay in can. Anyone who wants to sell can sell at this negotiated price. And there are these new investors who are coming in, and there are these dedicated secondary fund, continuation vehicle is the term of art. So it's called a continuation vehicle. You're like, world's worst name. But these secondary funds, which are absolutely massive, $10 billion funds, $15 billion funds, they will come in. Hamilton Lane is one that we know well, for example, and say, oh, the Washington State Investment or University of Washington wants to sell because the university is seeking liquidity right now for various capital projects. No problem. Hamilton Lane will buy at this price. It's anytime you're selling from one fund to another fund, anytime any of your LPs are being treated differently, you are in shark-infested waters. So you have to be very, very careful. The fact that investors don't have to do it, that they have a liquidity alternative is good. The risk you as a manager are taking is that you are guaranteed someone's going to be disappointed, right? Because the value is either going to go higher than expected or lower than expected, though it still might be up. And so either your sellers are going to wish they never sold, or your buyers are going to wish they hadn't bought into your continuation vehicle. So that's why it's fraught with sharks. But we do think there are a couple of companies, each portfolio, that we probably should try to hold on to for a longer period. So it's something we might consider in the future. But this is just short of SPACs in terms of trend factor. So we also kind of want to wait 5 years to make sure this isn't a flash in the pan.
Okay. Chris, really good question. I wasn't really aware of some of these end of life or end of fund life alternatives.
Yeah.
Chip Overstreet, you've got a question.
Yeah, Aaron, great presentation. I'm curious to get your thoughts on this new class of quote venture capitalists like Tiger Global that's just coming in and obliterating valuations and very limited due diligence, no board seats, and kind of a spray and pray kind of a mentality, primarily in the tech sector.
Yeah, no, totally. By the way, these are great questions because I am I get real boring talking to the computer screen on my own for too long. 7 years ago, you ask Tom or the guys at Madrona, Andreessen Horowitz, they're ruining the venture industry. These guys are drunken sailors, bunch of idiots. What are they doing? And their returns are, not. The returns have been great, and we are in this crazy market, Chip, where the tide just keeps coming in. And COVID was not a downturn. We all thought it would be a downturn. It's nuclear winter in 3 or 4 industries. Travel, tourism, blah blah blah, restaurants. But really, generally, has been a pretty darn good economy. So you're really looking back to 11 years ago that we had a real downturn when Warren Buffett got to see the tide out and the naked dudes. And so it's Tiger and a lot of other momentum type funds. And when you have a Fed policy that's this loose for this long, it just feels like there's capital everywhere. And as much as I want to say they're crazy, and they will get exposed if there's a downturn, so long as there's momentum, those guys can do pretty well. But boy, it makes it hard on investors who are really trying to engage with the companies, add value, be supportive. I mean, and this is going to sound like I'm just talking for the VC private equity industry, but see, there's a role for us to play and for true venture investors to play. I mean, good venture investors tell management teams the things they don't want to hear, and they should hear. And sometimes they are wrong, but that oozing with experience thing, some fair amount of the time they've hit the iceberg enough times that the management team should be aware of it. And so just raising dumb money may feel great in the short term, great price, there's no accountability, I can still do whatever I want. But actually that may not be the right thing for that personality, for that company. In fact, it is the right thing for it.
Is it changing your behavior, or do you see it changing other VC or private equity firms' behavior to be a little less, I don't know, little less due diligence, a little bit more generous with terms? Any changes at all?
Not so much in our world. It's kind of an adjacent world. And I'd say even a Madrona over in Seattle, who's kind of Washington's, bigger investor, I don't think they see it that much. But there are some companies, where Hollywood and venture capital have met, and they just know how to sell themselves. And it's like, oh my God, they've got the right resumes, the right story, where it's very hard for a traditional venture fund to even go near it, because the rounds are just going to start going from here to there. Whether anyone actually exits at a reasonable price is an open question. So yeah, I don't know, Chip. It's going to be interesting to watch that.
Good.
Absolutely.
Thank you. Thank
you.
Well,
Aaron, it's 1 o'clock and we try to finish right on time. I probably got 5 to 10 more questions, but clearly we don't have time for it. Maybe what I'd love to do, if you're in Spokane at all in the next 6 months or so, maybe we can kind of host an evening reception and people can have a chance to kind of get to meet you in person, and we can fire away with the questions that we didn't get to address today. But thank you very much, and thanks for everyone on the call. And I must say, this was the quality of questions were incredibly insightful.
Very engaging.
Really appreciate it. And you will be getting a gift set from Spiceology.
Right.
And when you are in Spokane next, I do encourage you to go out and meet with Chip and tour the company. I mean, doing a great job of disrupting a sleepy industry.
I'd love it. Yeah, I'm living in Chelan, so it's an easy hop, and I love getting over there. So every 3-4 months I'm there anyway. Let's do it. I'd enjoy meeting everyone in person.
Good. And thanks, Cindy, for helping organize this. Thanks to Rick Rep and Witherspoon Kelly. And don't forget to register for our next Ignite Talks on May 20th with Catalyst Interactive, a company with a fascinating new exercise device from Seattle, Aaron, following the kind of the Peloton mirror model. So look for that on May 20th. With that, we'll sign off. Thanks, everybody, and enjoy the rest of your week.
Take care, all.
Ciao.